In this week's video, we'll review the case for new highs in stocks versus the case for new lows. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. These are the major bullet points we'll be touching on this week. We have a lot to cover, so let's get right to the charts. Last week we noted that the Dow had not yet made a new weekly high, but was very close to doing so. The good news from a bullish perspective, fast forward a week, Friday, April 22nd, on the weekly chart, the Dow was up 106 points, and it did post a higher high on a weekly basis. However, the weekly candlestick paints a hesitant picture. We gave back a lot of gains at the end of the week. This wick here is somewhat of a toppy look, telling us to keep an open mind potentially about a reversal. After rallying sharply in a V-like manner, the S&P 500 remains inside of this orange box. Unbelievably, it entered the orange box 696 calendar days ago on May 27th, 2014, and we're still inside the box. The purpose of showing this, the big move still has not happened. There will be a very big move out of a pattern like this. It's going to be up or it's going to be down. The longer we go sideways, the bigger the move that we get. We don't know which direction it's going to be. The purpose of this week's video is to show both sides of the coin, allowing us to keep an open mind about bullish and bearish outcomes. If we can get the big move right, all of this will become rear view mirror material. It should be noted that the last three breaks from boxes have been bearish. In terms of the range, it's not like nothing has happened. We had a consolidation period here and a bearish breakout. This is a consolidation box. Bearish breakout here. This is a consolidation box. Bearish breakout here in early 2016. It would be impressive if the bulls could break out of one of these boxes, and it would be very impressive after making a low below this box if the S&P 500 could make a high above the box, something that we will respect if it happens in the next few weeks. That's not easy to do. S&P 500 weekly a week ago, April 15th. Fast forward a week, April 22nd, closing weekly. S&P 500 gained 10 points this week and moved up to the dotted line. This is potential resistance, and this is also potential resistance. It would be very impressive if we can break out in this direction here and hold that breakout. Emerging markets a week ago, April 15th. We noted on short takes this week that the Fed and the dollar played a big role in the current rally. Were emerging markets able to print a new high with the dollar showing some strength instead of weakness? The answer is no. A lower high, and we also gave back the gains during the week and actually finished down just a little bit, so roughly flat for EEM weekly. If we look at emerging markets relative to TLT weekly, we can see we have a similar looking wick and hesitation here in the candlestick that we had when the S&P 500 peaked in late October, early November. This look tells us to keep an open mind about migrating and adding back to some of our defensive positions. Maximum flexibility at this stage. On April 4th, we noted on short takes that cyclicals, or economically sensitive ETFs, seem to be losing their economic confidence look. Has anything changed since April 4th? Now we're looking at the ratio of SPHB relative to SPLV. economically sensitive or cyclicals relative to defensive stocks. On this side, think consumer staples. You can see we had noted in that article that this ratio had been dropping since March 7th. This doesn't look like confidence about future economic outcomes. This is a lower high and a lower low. Clients know that all things being equal, the model would prefer to make major decisions at the end of the week. So on Friday, April 8th, this still doesn't look that good. The reason for showing it will help us understand the improvement that's occurred in the model and the math and the observable evidence since Friday, April 8th. A week ago on Friday, April 15th, there is improvement here, but the last two trading days are negative or red days, and we have resistance here, so this really doesn't look that much different than this period here before a big plunge. If you follow along on Twitter during the week, you remember on April 20th, on Wednesday, we said the improvement in the evidence tracked by the model is very significant just over the last 8 trading sessions. So this is Wednesday, April 20th, the day of this tweet. Now we have a bullish breakout and what appears to be somewhat of a vertical ascent here. How did the exact same ratio look just 8 trading days prior? The answer is significantly weaker, and the data had been weakening for several weeks, looking back 8 sessions. So visually, you can understand how the observable evidence and the model readings improved dramatically in just 8 trading sessions. This is observable and measurable, and this vertical ascent is telling us that the observable evidence, the model, and the rules will require us to add to the growth side if things continue to improve and if the S&P 500 can continue to march higher and clear if-then hurdles. There's still a lot of evidence that supports the bearish and potential reversal case. However, we also have evidence that says we should keep an open mind about surprising outcomes to the upside. This chart tells us to keep an open mind. This chart says the bulls still have some work to do, and we know with that big move it could be to 2350 next. We could be going down towards 1600. The only way we can get these moves right if we maintain an incredible amount of flexibility and open-mindedness. Is it possible that we could add back to the conservative side? Absolutely, positively, yes. The bulls still control the tape. If the bears regain control of the tape, then we may be migrating our cash back to the conservative side. The market will decide where that cash will be invested. This chart, along with this long wick and give back and toppy looking candlestick here, tells us to keep an open mind about stocks moving in this direction. Notice the look of this candlestick here is very, very similar to the look of this candlestick here prior to a reversal. If we look at the S&P 500 SPY relative to TLT weekly as of Friday, April 22nd, we also get somewhat of a mixed bag. Again, we have a wick on this candlestick here. This looks very, very similar to this period here before the reversal. However, this move here looks better than this move here. Why? This is a move up with some consolidation and weakness and then a push higher. Here, we really went higher and then we reversed. So this is a little bit more confident look here. And also, if we flip this ratio upside down, it has somewhat of a concerning look for bonds. Notice here, this is a big spike in fear here. And this wick says that that spike in fear was reversed intra-week. The important part is after this decline, the next little spike in weekly fear. Notice how much lower this spike in fear is here relative to this spike in fear here. From a concerning perspective for bonds and a positive perspective for SPY and stocks, notice this historical example is somewhat similar. This is a big spike in fear here, a little bit of a wick and a reversal, and then the next spike in fear here in favor of TLT is significantly lower than the prior spike in fear. The chart we're looking at is dated August 7th, 2009. If we go to the let's see what happens next chart, this is the point we were looking at in here. This is your big spike in fear in favor of TLT. Then we come down and we get a much lower spike in fear. After that, this ratio continued to decline. This is a weekly chart in favor of SPY and against TLT. The first spike in fear was when the stock market bottomed in March of 2009. When this happens, you don't know what this is going to look like until it happens. So let's compare and contrast this period here, and this period here to the present day. This big spike in fear did coincide also with the market low on February 11th, 2016. Now, if you're a stock market bear and a bond bull, there's something here for you as well. We get somewhat of a reversal look here. Look at the look of this candlestick. It's very similar to the look of this candlestick here. What happened next after this candlestick? The stock market kind of went sideways for a few weeks, and then the stock market plunges and the ratio moves in favor of TLT. So this is an excellent keep an open mind about a reversal in stocks chart. And it also tells us to keep an open mind about a bigger than expected move in favor of SPY and against TLT. We'll learn something very, very soon based on what happens over the next few weeks. In this case, TLT popped back the next week and we somewhat had a consolidation period here. Notice we never really took out, went lower than this candle here. One possibility that we have to respect as well, if the Fed becomes more hawkish next week and hints at a potential interest rate hike in June, it is possible that the next few weeks are not particularly favorable for stocks or bonds. Rising interest rates are not particularly good for bonds, and they're not particularly good for stocks in the short run either. So having some cash on hand may not be a bad place to be, especially from a risk management perspective relative to expectations for next week. Expectations are that the Fed will not raise rates next week, but they will hint at an interest rate hike coming in June. That could be bad for stocks and bonds. That is one of many scenarios related to the Fed, but it is a very realistic scenario. As noted in detail last week on Short Takes, the Fed and the dollar have been a big part of the rally in stocks, crude oil, and weak dollar ETFs such as cyclicals and emerging markets. This chart sides potentially with the bearish case for stocks. This is the US dollar index here weekly. We came down near the bottom of the box, or the bottom of this blue trend channel here. This chart bottomed on May 11th. 10 calendar days later, the S&P 500 peaked. This chart bottomed on April 4th. It's possible that the S&P 500 has already peaked. We'll learn something relative to the movements in the dollar. It is also possible that Janet Yellen doubles down on the wealth effect theory. If the Fed is more dovish than expected next week, then it is possible that the US dollar index will break out of this consolidation. The longer you move sideways, the bigger the move that we can expect once we break out either to the upside or to the downside. One of the possible scenarios for better than expected outcomes for cyclicals, crude oil, emerging markets, and stocks is if the dollar breaks to the downside and has a big move in this direction. That is one of many scenarios. The bearish scenario for all of those assets is if it stays in the box and starts to move back to the top of the box and or the blue trend channel. As always, price will guide us. We'll learn something based on what happens with this chart. We've covered this chart in the past, so this is just an update. Intra-week, this chart broke below this line here. It closed back above it. This sides potentially with the bearish case for stocks. Like the previous chart, we'll learn something based on what happens next. 1 point on the weekly chart of crude oil as of the close on Friday, April 22nd. This is potentially a bullish engulfing candle here relative to this candle here. It's very, very difficult not to look at these two candles and say that is potentially a bullish setup. It needs to have follow through, but that's a good looking setup. On Twitter this week, April 21st, we asked the question, does asset class behavior this week look similar to the November-December 2015 reversal period in stocks? The answer was so far, no. Here's an example. This is economically sensitive materials relative to defensive TLT. This ratio was up 5.38% this week. Notice the tentative look in this ratio as the S&P 500 peaks and consolidates here, and this is where the S&P 500 plunges. This looks nothing like this here, telling us to keep an open mind about all outcomes, including a bullish breakout to the upside next week or in the coming weeks. Price will guide. It doesn't mean anything without follow through, but it's very, very difficult to look at these two candles and say that that is not potentially bullish for XLE. Here's another example where asset class behavior looks better today than it did during this peaking period here. Look at these two candlesticks here and this period here. It looks better than this period here. Fair and balanced. Australia was one of the big beneficiaries of the weaker dollar and the Fed here in 2016. Resistance, resistance, potential resistance. Small caps, I think it's fair to say that this move on the weekly chart looks more convincing than this move that was fully retraced. This chart of the NASDAQ puts some important things in perspective. You missed a gigantic move. Well, it's really not a gigantic move. The NASDAQ is actually lower than it was at the end of last year. So if you missed this move and this move, you really haven't missed anything in terms of the NASDAQ. Have to keep this in perspective. This came after this. This also tells us to keep an open mind about worse than expected outcomes. Haven't even been able to recapture this gap in what was a former leader. Here's another example of something that changed this week. During this retracement here. We never closed above the 61.8% level. During this bullish move here, we did eventually close above it. Until this week, we had not yet closed above the 61.8% retracement of this A to B move. Now we have. You never want to read too much into any one chart. This is one chart. We've cleared this level. All it does is tell us from a probability perspective to keep an open mind. NYSE Weekly. This move here, especially this period here, looks better than this reversal period here. Equal weight S&P 500 relative to TLT a week ago today. This does not look very convincing and confident. In fact, it looks very weak over the past few weeks. Fast forward a week, and we have another example of observable improvement in the hard data and evidence. Dividend stocks, SDY, they're defensive, but they're not as defensive as IEF. You can see a lot of confusion here since 2015. We had a bullish breakout in favor of SDY, but on April 7th, it really didn't look good, and it looked like it was about to fail. How does it look today, and is it siding with SDY or IEF? And did the breakout hold? This is another example of something that looks better than the previous peaking period here in late 2015. This doesn't really look anything like this, and this is a much more confident look than this. I think it's important to recap how difficult this market has been, and typically difficult markets are followed by easier markets. Look how many odd occurrences we've had back to back to back to back. We remember here, 2013 to early 2015, the V bottoms. This market and this ascent here was nothing like anything we had seen going back 65 years. Then we consolidated and went sideways in a very odd manner. In fact, the Dow consolidated in a way that it had never consolidated in its entire history here. Incredibly rare sideways activity. Then we had the plunge in August of 2015. By one metric, this plunge, we hadn't seen anything like it in 75 years. The behavior has been so odd for so long that you'll have to excuse me, I have to make this graphic bigger. After this plunge here, we went sideways for a few weeks, and then the central bankers started to talk again. Then we had all types of bullish occurrences in here. The S&P 500 went up for 6 consecutive weeks into late October, early November 2015. If you know your market history, typically when you get a bottom and the S&P 500 goes up for 6 consecutive weeks, that's very rare. Typically, it is incredibly bullish, and good things happen after something like this historically. But instead of following the historical script, we actually had a weekly plunge that was the worst weekly move after 6 weeks of consecutive gains in something like 50 years. Then the next week we went straight back up and almost retraced all of this loss, making it look like the bullish script was still in play. Then we consolidated for a few weeks after this peak in November of 2015. Typically, when you get a double bottom and 6 weeks of consecutive gains, markets typically would go on to make significant higher highs. That's not what we had. In fact, out of this, the 6th week, this was actually a peak. We never went higher than this intra-week high. And eventually, after this consolidation pattern, then we had another extremely rare and never seen before event. In early 2016, we had the worst 10-day start in stock market history. And the fun wasn't over yet. It's been a great time to be a market statistician. Since March of 2013, there has been incredibly rare market events that have occurred back to back to back to back to back. After the worst 10-day start in history, the central bankers started talking again here. Bloomberg called this, the rally that we're in now, the sharpest about face in 9 decades. Moral of the story, it's been frustrating for everyone. The key to success is to stick with your discipline and continue to execute. This odd market behavior also probably speaks to one of two things. We are probably going to get a very, very big move after something like this. And it may be, if it's to the downside, that these are high risk markets potentially. That's purely conjecture, and price in the markets will decide whether we're moving higher or lower. When we were down here and in this period here, did the fundamentals tell us get ready for the sharpest about face seen in stocks in 9 decades? I want to give credit where credit is due. This is an excellent article from CNBC. If you Google this title, you can find it. We'll be quoting from the article. According to Zacks Financial Research, total earnings for Q1 are expected to be down 11.1% on negative 2.3% revenues. Earnings growth is expected to be negative for 11 of the 16 sectors that Zacks covers. The negative earnings growth in Q1 will be the 4th quarter in a row of earnings declines for the S&P 500. Margin debt as a percentage of the economy is higher today than it was in both the year 2000 and 2007. The median price to earnings ratio currently sits at 22.6. That's higher than the level found at the market peak in 2007 before the financial crisis. The price to sales ratio is now not only higher than it was in 2007, but also at any other time in history, with the exception of the internet bubble peak in the year 2000. The total market cap of corporations in relation to the economy is also higher now than at any other time in history outside of the NASDAQ bubble. With all of that bad news, how is it possible that markets could push higher? Markets are forecasting mechanisms. Therefore, markets may push higher based on anticipated future improvement in the fundamentals. Poor fundamentals, just like poor charts, can improve at any time. Thus, we have to head into next week with maximum flexibility. Price will be our guide. Can we find an example from history where the economic data was terrible, sentiment and confidence was very, very poor, and after that, good things happened? Yes, 1982. I can't emphasize enough. We are not saying 1982 is similar to the present day. We are simply saying it is an anecdotal example of a period where confidence and sentiment were very, very negative, and the economic data in hand was very, very negative. The 1981-82 recession was the worst economic downturn in the United States since the Great Depression. Indeed, the nearly 11% unemployment rate reached in 1982 remains the apex of the post-World War II era. For those of you that weren't around in 1981-1982, what happened in the stock market after all of this horrible economic data and pessimism? While no one would have anticipated it, the S&P 500 started an 18-year incredibly strong secular bull market. We fully understand that the present day is radically different than 1982, simply using it as an example where pessimism was high and the economic data was horrible, and after that, good things happened. Not a forecast about the present day. One more point about the odds of new highs. We talk to people in New York all the time. Numerous professional money managers are still on the wrong side of this market, and they may have to unwind defensive or bearish positions if we move higher and then move into growth assets. From a new lows perspective, we need to respect that this market may be a one-trick Fed-induced pony. We also need to respect that the Fed is way behind on fighting inflation, as we outlined in detail on short takes, and similar sharp V-type rallies have failed since October of 2014. Therefore, we will head into next week with that always important, flexible, unbiased, and open mind, understanding that a big move could be coming in this direction or this direction, which means the cash that we have in our portfolios right now may be redeployed into growth-oriented assets, or that cash may be redeployed into conservative or defensive assets. The market will make that decision for us. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.